Welcome to IP Concerns Deep Dive, the podcast version of our IP Concerns blog from Cascade Law Group. Here, we unpack intellectual property-related, real business and brand protection topics in a way that actually makes sense, no legal experience required.
Everlane, the millennial poster child for ethical, radically transparent fashion.
Right.
Well, they were just bought by SHEIN. Yes, that's SHEIN. The ultra-fast fashion giant that's basically notorious for, massive pollution and those ongoing labor controversies.
Yeah, it sounds completely made up.
It really does. It sounds like a glitch in the Matrix, doesn't it?
Oh, absolutely.
Yeah.
It genuinely feels like two alternate realities just colliding.
Yeah.
You have this brand built entirely on the promise of guilt-free, high-quality basics, and suddenly it's swallowed whole by the exact corporate behemoth it was created to counteract.
Exactly. And the immediate consumer backlash online has been, it's been fierce. People are calling this the ultimate corporate betrayal.
A textbook sellout.
Right, a textbook sellout. And honestly, if you listening have ever bought an Everlane sweater because you really believed in their whole know your factory's mission, well, you can't be blamed for feeling that way.
Totally understandable.
But our mission today for this deep dive is to kind of move past that initial emotional shock. We are diving into this really fascinating source article titled "The Paradox of Radical Transparency."
It's a great piece.
It really is. So instead of just joining the internet outrage, we're going to peel back the layers of, corporate governance, intellectual property, and macroeconomic pressure to figure out why this reported $100 million deal actually went through.
Because when you look at the underlying mechanics of this acquisition, it stops looking like a sudden loss of morals.
Yeah.
And it starts looking like an inevitable collision of business realities.
Yeah.
Deals of this magnitude, they have a very specific, almost unavoidable architecture to them.
Okay, let's unpack this. Because to understand why Everlane's leadership would ever agree to just, hand over the keys to SHEIN, we have to look at what was actually happening inside the building.
Right.
Because the Everlane that was just sold wasn't the idealistic, independent startup that most consumers pictured in their heads.
No, not at all. And that's the crucial first layer we need to peel back here. The narrative of the scrappy, independent disruptor fighting against the big bad industry.
It's great marketing.
It is incredibly powerful marketing.
Yeah.
But it rarely reflects the mature stage of these companies. Everlane's majority owner wasn't a collective of idealistic designers.
Right.
It was a massive private equity firm named L. Catterton.
And according to our source, they were sitting on incredibly shaky financial ground. They were carrying a reported $90 million in debt.
Yeah. $90 million.
Just let that sink in for a second. $90 million in debt for an apparel brand. Plus, they were suffering staggering losses in an affordable luxury market that had just become, wildly saturated over the last few years.
Especially as consumer spending shifted post-pandemic, yeah.
Exactly.
And that financial reality completely shifts the decision-making paradigm. When a private equity firm is at the helm and the company is carrying that level of crushing debt, the idealistic mission statement painted on the office wall, it takes a backseat to sheer survival. Private equity operates on a mandate of return on investment, not philanthropy.
Right. It makes me think of an automated emergency brake on a high-speed train.
Oh, I'll get that.
Imagine you're the conductor, and your goal is to get to this beautiful utopian destination, but you're burning through fuel way too fast, you're ignoring all the warning lights, and the train is suddenly careening toward a cliff.
Yeah.
That emergency brake kicks in automatically. It doesn't care about your beautiful destination. It activates to strip you of your control just to stop the train from going over the edge and destroying the cargo.
That's a really great way to visualize it.
Yeah.
And, in the corporate world, that emergency brake actually has a legal name.
Oh, really?
Yeah, it's called fiduciary duty. What's fascinating here is that in business law, directors and majority shareholders like L. Catterton in this scenario, they owe a strict legal fiduciary duty to maximize shareholder value and mitigate corporate losses.
So it's not just a suggestion to pivot when things get tough.
No.
It's a binding requirement. You literally can't legally ride a company into the ground burning through investor cash just to uphold a philosophy of radical transparency.
Exactly. It's an absolute survival instinct mandated by law. When an enterprise is that heavily leveraged with debt and bleeding cash, a fire sale often becomes the only viable lifeline.
So they basically had no choice.
Right. The board has a legal obligation to prevent total bankruptcy, to protect the creditors who lent them that $90 million
Wow.
and to salvage whatever residual value is left of the enterprise. From a strict legal and financial standpoint, L. Catterton did what private equity firms are designed to do. They triggered the emergency brake and cut their losses.
Okay, so the desperation from Everland's side makes total sense. They had to pull the brake. But, and this is the big question, if they were desperate to sell, why on earth was SHEIN the one picking up the phone?
That is the big question.
Right. What does a fast fashion machine that churns out thousands of cheap items a day actually want with a distressed, premium, ethical brand?
Well, when we see a $100 million acquisition of an apparel company, our natural assumption is that the buyer wants warehouses full of T-shirts and jeans.
Right. Or like prime retail real estate.
Exactly. But when a giant like SHEIN acquires a distressed asset like Everlane, they aren't primarily interested in clearing out backstock inventory. They are executing an intellectual property or IP acquisition.
Ah, okay. And the crown jewel of that IP portfolio is the trademark itself, the brand equity.
Yep.
Because our source points out that SHEIN has been trying to execute an initial public offering, an IPO, for quite some time now.
They desperately want to go public.
Right. But those plans are stalled because of really intense scrutiny from regulators and Western lawmakers.
The regulatory environment for SHEIN is incredibly hostile right now.
Yeah.
And to understand why this trademark is so valuable, we really have to look at how a modern IPO actually works. When a company goes public, they aren't just selling their stock to retail traders on an app. They rely on massive institutional investors.
Like who?
Think massive state pension funds, mutual funds, large asset managers, entities buying millions of shares at once.
Right. But those institutional investors don't just look at profit anymore, do they? I mean, they are heavily graded on ESG scores.
Exactly. Environmental, social, and governance metrics.
Okay.
And that's the massive barrier SHEIN is hitting. Many of these huge funds have strict internal bylaws. They might be legally barred from investing heavily in a company with a toxic ESG profile.
Wow. So by buying Everlane's globally recognized, highly trusted trademark, SHEIN buys an immediate shortcut.
Yes.
They gain this like halo of eco-conscious legitimacy, and they acquire a brand that historically appealed to the exact demographic and investor class that previously just refused to touch the SHEIN platform.
If we connect this to the bigger picture, that's exactly the play.
Here's where it gets really interesting, though, because I have to push back on that logic a little bit.
Okay, go for it.
Will a halo effect actually work here? Like, if consumers are already all over the internet calling this a corporate betrayal, won't that eco-conscious demographic just abandon Everlane now that SHEIN owns it?
That's a fair point.
I mean, the magic spell of feeling good about your purchase is kind of broken, right?
A highly vocal segment of their core demographic will undoubtedly leave. There's no question. And SHEIN's analysts definitely factored that churn into the $100 million price tag.
So they expect to lose customers?
Oh, absolutely. But SHEIN isn't necessarily banking on retaining every single legacy Everlane customer. They are buying institutional legitimacy. They're trying to artificially graft a decade of brand trust and positive media associations onto their own reputation.
So it's more for the investors and the shoppers.
Exactly. Even if Everlane's retail sales dip a bit, having a respected, radical transparency brand in their corporate portfolio fundamentally changes the narrative they can present to those institutional investors.
But wait, if lawmakers and Wall Street analysts see through this halo purchase, and let's be honest, it's pretty transparent greenwashing, doesn't it blow up in SHEIN's face anyway?
Well,
Because they can't just slap an Everlane sticker on a SHEIN factory and call it a day. Institutional investors aren't stupid.
no, they aren't. And you're touching on the real core issue here. Institutional investors need plausible deniability and risk mitigation. They need hard data to justify their investments to their own stakeholders. And that brings us to the second highly valuable part of the IP portfolio that SHEIN acquired. They aren't just buying the sticker, they're buying the engine behind the sticker to prove they are genuinely evolving.
The proprietary supply chain data.
There it is.
The source highlights this perfectly. Everlane didn't just market sustainability, right? They actually did the grueling, capital-intensive work of innovating in this space.
For over a decade.
Right. For over a decade, they invested heavily in materials research, developing low-impact dyes, perfecting methodologies for using recycled plastics in apparel.
This is systemic knowledge. This internal data represents highly valuable proprietary IP.
Yeah.
They figured out how to manufacture apparel at scale with a significantly smaller environmental footprint, and they documented the entire process.
So to use an analogy, it's kind of like being back in school. Shein didn't just buy a rival school's jersey to wear around so they look smart.
Right.
They bought 10 years of their smartest competitors' painstakingly researched playbook, and they're basically going to pass it off as their own homework.
It is spot on.
But how does that actually work in practice? I mean, how does a behemoth like Shein physically absorb Everlane's data? It's not just a USB drive they plug into a computer, right?
Right. No, it happens through operational integration.
Yeah.
So Shein's core business model is built on highly agile software that bids out orders to thousands of independent manufacturers.
Okay.
Now, Shein can take Everlane's vetted supplier list. These are factories that Everlane spent years auditing for ethical and environmental standards.
Well,
And they can route some of its own higher-tier product lines through those specific factories.
oh, wow. Wait, really?
Yeah,
So they take the R&D that Everlane perfected on a relatively small scale, and they can just force multiply it across Shein's enormous global manufacturing footprint?
it goes even further than that,
Right.
actually. Shein can take Everlane's technical specs, so say the exact chemical formula and heating process for a low-impact fabric dye.
Okay.
They plug it into their supplier software, and they mandate that their existing network of factories must adopt this specific process if they want to keep receiving Shein's massive orders.
That is wild.
It is. And when regulators in Europe or the U.S. start mandating strict environmental impact metrics, Shein suddenly have a treasure trove of tested methodologies they can implement immediately to ward off regulatory fines.
It's wild when you frame it like that. I mean, $100 million sounds like a massive price tag for a clothing brand that is bleeding cash.
Sure does.
But it's an absolute bargain for a robust IPO defense shield and a decade of green tech R&D.
Exactly. The underlying value was never in the current season's inventory of cardigans and slacks.
Right.
The value was in the systemic knowledge Everlane had built and the corporate legitimacy that knowledge buys for a company desperately trying to go public.
This structural reality really forces us to reevaluate the entire era of companies that Everlane came from, doesn't it?
Oh, without a doubt.
Because our source material makes a fascinating pivot here, pointing out that this acquisition isn't an isolated incident.
No, it's not.
It's the natural conclusion of what business analysts call the venture-backed DTC 1.0 era, direct-to-consumer.
Right. And to understand that era, we have to look back at the 2010s.
Ah, the golden age of Instagram ads.
Exactly. That decade was fueled by an environment of historically low interest rates. Cheap venture capital was flowing freely into Silicon Valley and beyond.
Yeah.
And this allowed a whole wave of direct-to-consumer companies, selling everything from mattresses to glasses to ethical T-shirts, to prioritize explosive growth and high-minded mission statements over actual sustainable profits.
And to understand why that model eventually crashed, we need to talk about a concept our source leans heavily on, which is unit economics.
Yes. Crucial concept.
Let's define that simply for everyone listening. Unit economics basically asks, on a per-item basis, is your business actually making money?
Right. Sounds simple, but it gets complicated.
Yeah, like, let's say it costs you $10 to manufacture a shirt, and you sell it to a customer for $30. On the surface, that sounds like a $20 profit.
Right. Nice and easy.
But what if it costs you $25 in targeted social media ads just to get that specific customer to click buy?
Well, in that scenario, you are losing $5 on every single shirt you sell.
Exactly.
That's bad unit economics.
Yeah.
You are essentially paying people to wear your clothes, subsidizing the cost with venture capital money, just to show user growth to your investors.
And for a lot of these DTC 1.0 companies, that was the exact reality. They were absolute masters of branding and customer acquisition, but the underlying unit economics were deeply flawed.
Because you can't outmarket bad unit economics forever.
Right.
Eventually, macroeconomic conditions change. The cheap venture capital dries up, interest rates go up, making borrowing way more expensive.
Yep.
And the massive debts these companies took on to fuel their growth suddenly come due. And when that happens, the market doesn't care about your radical transparency or your beautiful packaging. It cares about solvency.
And our source specifically points to Allbirds as another high-profile example of this exact phenomenon.
Yes, perfect example.
Allbirds was another massive DTC darling, famous for those sustainable wool shoes that basically became the unofficial uniform of Silicon Valley for a while.
Oh yeah, you saw them everywhere.
Right. And
Okay.
they built their entire identity around lowering their carbon footprint and fighting climate change.
But the financial realities caught up to them as well. They faced massive stock price drops, forced store closures, and they actually had to completely restructure their business model earlier this year. Why? Because, just like Everlane, their underlying unit economics weren't supporting the sprawling retail operation they had built. They expanded way too fast into physical retail and moved away from their core products.
And all of it was funded by that early wave of cheap capital.
Exactly.
So both Everlane and Allbirds basically proved a very harsh lesson here. High-minded ethics mean absolutely nothing if they aren't backed by a functional, profitable business model.
It's true.
You can have the most transparent supply chain in the world, but if it costs you more to acquire a customer than that customer spends, the math will eventually crush you.
It's a really sobering reality check for anyone who thought we could simply, shop our way to a better world without fundamentally changing the economic systems underneath these brands.
Yeah.
The ideals were genuine, I believe that. But the financial architecture supporting them was incredibly fragile.
So what does this all mean for us as consumers? We started this deep dive looking at a headline that felt like a total glitch in the matrix. Was this acquisition a sellout? Culturally, absolutely. I mean, Everlane built its brand equity on being the anti-SHEIN.
Yes, they did.
To end up owned by them is the definition of deeply ironic.
Culturally, it's a very bitter pill for loyal customers to swallow. But legally and commercially, the structural business reality will always supersede the marketing copy.
Yeah.
We expect our ethical brands to be pure, right? To be immune to the gravitational pull of massive conglomerates. But gravity always wins when there's $90 million in debt holding you down.
Wow. Which leaves us with a final, somewhat provocative thought for you to mull over. We've seen how radical transparency and years of ethical innovation ultimately ended up being absorbed by the very opaque behemoth they were created to disrupt.
It really makes you wonder.
It does. It makes you wonder. Can ethical consumerism ever truly scale under the traditional private equity model? Or, in the grand scheme of things, are idealistic, venture-backed startups destined to just become the unofficial, unpaid research and development arms for mega corporations?
That is the big question.
Think about that the next time you see a new brand promising to change the world. Thanks for joining us on this deep dive.